Hi, I'm Susanna Byler, a manager on the tax team at Kirkering Barberio. With the passing of the One Big Beautiful Bill Act, which you will hear us refer to as OB3A or ABA, major tax changes are on the horizon, and in some cases, they're already here. OB3A contains various tax provision extensions as well as completely new provisions. And today we're going to look at two of those new provisions. The first item we'll discuss is the car loan interest deduction, which taxpayers may qualify for the deduction, and then which car loans as well are qualified for that purpose. Next, we'll look at the new Trump accounts and who may contribute to those accounts, as well as the taxation and distribution rules for those accounts. These are evolving topics, and as we have more information, we'll continue to update you. If you have any questions, please feel free to reach out to me. And I'm going to pass it over to my colleague Erica now to discuss the first topic.
Hi, I'm Erica Sims, and I'm an in-charge accountant on the healthcare team at Kirkland Barberio. Today, I'm going to talk about the One Big Beautiful Bill Act and how this new legislation impacts individual tax planning. While the bill is now official, we do expect some more technical guidance and clarifications in the months ahead. Let's take a quick look at some of the key changes affecting your individual taxes. What's happening with the no tax on car loan interest? Effective 2025 through 2028, individuals can deduct up to $10,000 in interest paid on a loan used to purchase a qualified vehicle. The deduction phases out for taxpayers with a modified adjusted gross income over $100,000, $200,000 for married filing jointly. For every $1,000 of modified adjusted gross income above these thresholds, the deduction is reduced by $200 until fully phased out. To qualify for the deduction, the interest must be paid on car loans that originated after December 31st, 2024, or interest on any personal vehicle that is later refinanced. The taxpayer must be the original owner of the vehicle. Used vehicles do not qualify. The vehicle must be used for personal use only. A qualified vehicle is a car, minivan, SUV, pickup truck, or motorcycle with a gross vehicle weight rating of less than 14,000 pounds, and that has undergone final assembly in the United States. These vehicles do not qualify for this deduction. This deduction is available even if you do not itemize your other deductions. And now over to my colleague, Daphne, who's going to talk to you about the Trump account.
Hi, I'm Daphne Maldonado, a staff accountant at Kirkring Barberio. Today, I'm going to talk about the Trump accounts. So what is the contribution limit for the Trump accounts? The annual contribution limit for the Trump accounts is $5,000 per beneficiary. Contributions may come from parents, relatives, employers, charitable organizations, and government entities. These accounts are structured as non-Roth IRAs for the exclusive benefit of minors. Trump accounts funds must be invested in the mutual funds or indexed ETFs that tracks U.S. equity markets. A child must be a U.S. citizen with a valid Social Security to qualify. Employer contributions are not included in the employee's income with a contribution limit of $2,500. General funding contributions from charities or government bodies are exempt from the $5,000 limit, as long as they benefit a defined group. Additionally, a one-time federal contribution of $1,000 will be made to Trump accounts for eligible children born between January 1st, 2025 to December 31st, 2028. If a qualifying child does not have an account by the time they are claimed on a tax return as a dependent, the IRS will automatically open one unless the parents opt out. So what are the distribution limits for the Trump accounts? Distributions from Trump accounts may not occur until the year beneficiary turns 18, except in limited qualifying cases. Distributions are taxed at ordinary income rates to the extent of gain. Contributions that are withdrawn are generally tax-free, but a 10% early distribution penalty will apply to funds that are not used for qualifying purposes. First-time home purchases, higher education expenses, and medical expenses, among others. The one-time federal contribution of $1,000 and any general funding contribution or employer contributions do not create a basis in the plan and are taxable upon distribution. If you have any questions around how the One Big Beautiful Bill could impact your individual taxes, please contact your Kirkering Barbario representative or Sue Byler. You can also visit our website for additional resources and updates at kbgrp.com.